Hello and welcome to the second part of this chat with Varun, where we are sitting and talking about the small cap space. In this part of the conversation, I want to talk about how our fund is really constructed and how you went about deploying the funds. How did you go about doing it when there had already been a correction for some time? Do you think you were able to get, very attractive prices? Just to start off with, it's also why our NAV never suffered really.
Yeah. So I think, yes, in hindsight, of course, it does look like a good entry point. But while we were deploying it, of course,
there was
there was, of course, a lot of volatility, a lot of, I remember people sending me, congratulations, you have made the market peak with the launch of our NFO. But, I think, I've been in the markets for almost 18 years, right? And every 4 or 5 years, there is a 25-30% cut in small cap. That's no new thing, right? And you always know there will be a different side of the market pretty soon. Sometimes it takes 6 months, sometimes it takes a year, sometimes a little longer, but invariably, and you have to ride through that journey. And in fact, the best opportunities also tend to come in the periods of extreme volatility, which is what we believe actually happened. So from the peak to the trough, the market index was down around 26%. And from there, I think we have bounced almost 15%.
Yeah.
So there's been a fairly, quick movements on both sides, and of course we have used that opportunity to get into the right names at the right valuation. Also, one important thing from a volatility management perspective, SEBI allows us to have 35% of the portfolio in large and mid, right? So you need to have at least 65% in small cap, and the balance could be in large and mid. So early on, when we were deploying the money, we use some of that to make sure that there is some stability also coming in the portfolio. And as the AUM is coming in, as more and more investors are coming in, we are gradually decreasing the allocation of mid and large. So as we speak today, we are only 23% in large and mid compared to 35%. And no, it's naturally coming as more inflows coming. So incrementally, we are deploying money largely in the small cap space. So that, I think, in the next 6 months, we will bring it down further to, let's say, 10-12%, and 85 to 90% should be in the small cap space.
Okay, got it. How long did it take you, by the way, to put in all of this 1,000 crores? I know now there's a new SEBI rule on it, but our fund launched before that.
Yeah, so we are, NAV date was 31st January, and we get 1 month. SEBI gives you 1 month to create the portfolio. And for us, the litmus test was the first day of the fund, which is 1st February, was a budget day. Right? So,
you plan it like
you never know. So that was, if you ask me, that was the most stressful day for me. It's like, because anything could happen. We have had 10% moves on budget days in the past, right? So we used that day and we got the exposure through the use of some derivative instruments, and which were later paid off. So as of now, there is no derivative instrument in the portfolio, but that time we made sure that we had the full exposure. And also we are on a 95-96% exposure from first day itself. And gradually we took that 1 month to create the portfolio. And since then, we have not been keeping any cash, I think to the extent of 1 or 2%. Otherwise, the portfolio is almost fully invested.
Yeah, okay. Mirae anyway does not believe in sitting on cash. So we like to be fully deployed. And if things ever get to a point where we just cannot invest, like it has happened in the past, then we will stop accepting subscriptions. That is our logic. But we also believe in growth at a reasonable price, right? So within the small cap space, tell me, where do you see growth and where do you think it's coming in at a reasonable price? If you could just split the current portfolio.
Sure. So if I look at the portfolio, we have around 22-23% in the BFSI space, which is your banking and financial services. So we have small banks, small finance banks, small private banks, we have PSU banks, we also have NBFCs, some of the auto-focused NBFCs, so diversified NBFCs. So which is a space, like I said, we expect significant monetary easing this year. So we expect that space to do well. Second, we have very large exposure to healthcare space. So I think mid double-digit kind of exposure. So we are very positive on the whole hospitals diagnostic space. That is a shift from unorganized to organized kind of a story, and that journey will continue. I think post-COVID, all of us have realized that we don't want to go to your neighborhood nursing home. We all want to go to the best corporate hospital. And because that's being paid by insurance more and more. So that is another big theme. Then we are very positive on CDMO, which is the contract research and manufacturing in the pharma space. We believe a lot more work will come India's way, irrespective of what happens to the tariff picture. Then we have a lot of exposure on, like I said, engineering, capital goods, We believe that is a space which should continue to see good growth. So I think around 16-17% of the portfolio is on the whole capital goods, engineering, defense, some of those names, which is very sizable exposure. Then we also have around 6% of the portfolio on the chemicals. And of course, these numbers, percentages can change, right, depending on how much inflows we get and all those things. But these are broad ballpark kind of numbers. And again, then we have a fairly large number of bottom-up ideas in those sectors and themes where we believe we should see good growth going forward. What we are doing is building the portfolio from a 3 to 5 year perspective.
Okay, understood. I just want to ask you one more question on healthcare, because you mentioned that, it is usually considered that good defensive sector to have when times are uncertain. Of course, this time there's been that googly, on the tariffs, which has not let it kind of recover as much as even the rest of the market. Does that worry you? Is that why you're playing hospitals more than, some of the other names?
No, so we have a good balance. Okay. We have hospitals, we have diagnostics, we have CDMO, we have pharma. So we have present in all spectrum of the healthcare opportunity. And we are looking at more from a 3 year perspective. In our view, what is domestic? So the portfolio is a lot of domestic or inward-looking stories, right? So which are going to be unimpacted by tariffs or a global economic slowdown or US recession or what is being talked about or what could have happened. So our portfolio is designed to capture the India growth story. Of course, some companies will also do very well from an export perspective, right? So for instance, today India Defense will participate more and more from an export perspective. So that is one great story. A lot of auto ancillary companies in India are big exporters, so which is also part of the portfolio. Chemicals is largely export story. So that is again something which is present in the portfolio. So we have all those, but I think 70-80% of the portfolio is geared towards the domestic growth. And
so
that
should not be doing bad.
And that should be doing fine.
Okay. That is, I'm sure, comforting for a lot of people to know, because there have been some questions on the healthcare space, especially because people expected it to do better. The second thing which you had told me earlier, and I want you to, say to anyone that's tuning in now, is that even within the fund, when you buy in a staggered manner, right? So it's not like if you like one stock, you're going to go and put everything in it at one point. You do try to get an average price, so that even if you get in today and tomorrow, if the market is to fall, for example, you can still get a lower entry price. Can you just explain that and how you go about this?
Yeah, so the idea is that you should be able, the average cost of buying of any stock should be reasonable, right? But you cannot wait for the best price, because then you never know how the stock price will react. So if you like something with certain margin of safety, you want to start buying. Sometimes you're able to get a lot of quantity in one session. Sometimes it takes several days. So it's a mix of those things. Sometimes you build a small position and wait for more conviction. So let's say you could wait for a quarter and the results to come in and to get more clarity and conviction in that idea. So it depends on what story, what idea you are particularly working on.
Okay, understood. I also want your views on, are there any pockets right now? I know you mentioned some earlier, whether they're capital goods, capital market plays, where you are waiting for better prices. So essentially places where you like the companies, but you're not willing to invest right now. And I also want to ask you on defense, because the number of questions I get on defense is just...
Okay, so first, I personally, I'm a believer in the defense story. So
it's also a story which normally runs in long cycles, right? You don't expect it to get over in a year.
So this is a 5-year or 10-year story. And in the environment that we live in, right, geopolitical environment, India needs a strong defense, and we need to have a strong indigenous defense production. We can't be dependent on other countries for critical products. So I think now Government of India has been very clear. I think they started liberalizing the sector 3-4 years back, and the fruits of that are visible now. I think this will continue. We will see not just the defense PSUs doing well, but even several private sector companies. In fact, if you look at the most large corporate houses, they are also setting up defense manufacturing units.
But are these, including the PSUs, do you think they're expensive or not?
Yeah, so to the second part of your question is, we are underweight. Like I said, 20% is the total weight of cap goods / engineering / defense in the small cap index. We are currently 16-17%, so we are underweight. We would definitely want to have more of defense, but at our valuation that we feel comfortable with. So that is one space that we are definitely waiting for some correction. Certain part of capital market, that is again a 10-year theme. It's a definite.
Look at the way people are participating. Is it not going to go away?
I don't think it's going to go away, right? And and we have seen that in US. It's 20 years, the industry became 20 times, right? And I see no reason why it should be different here. So all these stocks, but some of them continue to trade at a very expensive valuation. So I think another pocket where we are underweight. and we would want to wait for better entry opportunities.
Okay, so these are all part of the watch list. It's very interesting to know how the fund is created. Of course, I've spoken to you on this, but I thought it'll be nice for our investors also to hear where you stand on these individual sectors. We will be back for more, and then I am going to get into how Varun likes to invest his own money, what funds, what do you look at for your kids, for example. We'll talk all about that on the other side.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.